Hey, can you hear me?
I hear you, Michael. Good morning.
Hey, thank you for joining me.
Oh, thanks for doing what you do. Thanks for making yourself available.
Yeah,
I
sure,
know
sure.
I appreciate it, and I'm sure all the other team members do as well.
Cool, man. Thank you. I'm just give it a couple of minutes, see if anyone's going to show up. Not sure if anyone's going to show up because it's middle of summer. Don't know how it's going to go. But I've got some stuff that I kind of feel that is helpful, and I'm making a recording. And yeah, if people want to, they can always engage with it afterwards. Yeah, I'll just give it another minute. How you doing? You okay?
I'm fine. Um, oh, I have a question for you to consider. You, of course, have a list of stocks that you're recommending. Have you thought of whether and I know you want like equal amounts to each stock for
Mhm.
the diversification. But would it be a good reason to put a priority or like a preference or maybe like a confidence level saying, this I have more confidence than others?
So the reason why I don't do that, because it's quite difficult. In the ideal scenario, you'd have put five stocks and you have 10 stocks. And the five stocks you have high confidence they would do 15% per year and you'd be really happy. But in reality, life is really messy. And sometimes you have a position that you don't think is going to actually do that well. And it surprises you quite nicely. So for
Right.
Builder's first source is a lumber commodity company, and it's done really well. And if you compare it with its peer, Blue Links, it's really done a lot better than Blue Links. And on the surface, there's not a lot to distinguish these two companies. They're both highly contingent on lumber prices. Yes, one is slightly better quality than another. That's Builder's first source, but I wouldn't have expected to have been up 100% at one point in the past 12 months. So, it's really difficult. You just try your best. And the same, let's say, for example, with Buffett, Buffett always says that he invested in Disney and then he sold out of Disney. And if he'd held it for all that period, he'd done really, really well. And you go with the cards that you have, and with a lot of room for uncertainty. And it is difficult at the onset to know how something is going to unfold. And I also mentioned that last week when I said that you don't really know much about a business until you're the owner of that business. And then you really kind of go through the motions and you learn quite a bit about that business. So I don't know if anyone else is coming. So I'll just kind of crack on and we'll see how it goes. So I was going to pick out three companies. I was going to pick out one company that has worked out well and two companies that I didn't own, but I'd written about them publicly. And one could see even before the results were out that there were problems on their balance sheet. So I'm going to go for one that worked out well, and then two that we can use as case studies of that. Even if you didn't know beforehand how things were going to turn negatively, you could have seen that there were question marks there. So let me just see if there's any way I can just share my screen here. 1 second, please. I can't remember how to do this. Just bear with me a second. I do apologize.
Sure.
I can't remember. Anyway, it doesn't really matter for our purposes. So if someone goes on SEC filings, so just on Google, if someone types in, for example, SEC filings or company filings, hi Dan, I'll just kind of explaining that we're going to go through one company that, can you hear me, Dan? Just by the way, can you hear me?
Yeah.
We're going to go for one company which has worked out well, and two companies that that I've written about that were unlikely to work out well, and the one could have foreseen ahead of time that there were question marks on the balance sheets. So the one company that has worked out well was United States Steel. And if someone goes, I know that Dan, you're quite familiar with that, but someone else, if they want to go through and check and see on SEC filings, you on Google, you can go on a company's 10K. So next week, I'm going to talk about how someone should navigate a proxy statement and how someone should have a bit of an understanding when a company's free cash flows and earnings don't align. So that's kind of more of an advanced level, but I'm trying to provide some kind of base here that people can kind of think about and then use that for their own picks. So with United States Steel, so there are three main filings that a company regularly reports. This is the 10K, which is an annual report. 10Q stands for quarter, and then 8K. Often, if a company is down, let's say at the open, and it's down, let's say 10-15%, just go on SEC filings and just look to see if there's been on the day published an 8K, that maybe they're having a capital raise of some sort. That just provides you with some context if the market is overreacting or not. So if you just see that your stock is down a considerable amount and doesn't seem to be any kind of press release, just look to see on SEC filings to see if there's been an 8K release that morning. Often, if it is the case, or there's insider selling or something, just for you to kind of have, a bit of understanding of the company that you own, what's happened there. Okay, so my preferred way is to look on the 10K, because 10K is reported annually. It's a very full, with a lot of information filing, and it's written in a way that once you kind of you spend a bit of time reading through these, they're very, very similar in terms of what's written there. So if you just get into the habit of spending a few minutes looking at this, it just becomes something that kind of becomes like your second, like just your instinct. You kind of know what to look for. So within the 10K, there is 3 sections that are quite important, okay? The first one is the risk factors. The second one is the financial statements. And then there is the management discussion. So these are the 3 things that you really need to be aware of. And you don't need to read everything. If you read the top 3 things on the risk factors, you will find 1, 2, or 3 what is really management trying to say is the actual risk of the business. Because they have a lot of things that say, oh, if customers don't pay up, this and that. This is normally quite low down on the list. It's not on the top 3. The top 3 is, even I would say, narrow it down really, it's the second one that is the top risk factor that I would say. The first one is our share price can go up and down or something like that. It's not really kind of something that everyone knows that. But the second one is really where management says, okay, this is the risk that you should be aware of, because he didn't want to get sued. You just spend a couple of minutes, you go on that risk factors 1, 2, or 3, and you just read through that. The second thing is on the debt aspect. Okay, so the examples that I was going to provide, and I'm going to write this up, is on United States Steel. So the example is here. Okay, so this, you just type in, you Control F, you type in the word debt or borrowings. If it's an international company, often the company will report in the words borrowings. But if you look at the company, if it's a US-based company, they often say debt or convertible senior notes. So just type a couple of words like debt or senior, and you'll find out some stuff there. Another key word that's quite helpful is to type in the word revolver or revolving. So if it has, let's say, an off-balance sheet amount of debt, it will be called a revolver or revolving or a credit note. So if you type in the words revolver or something or credit, you will find that there may be something that is not really on the balance sheet. This, for most companies, will be relatively small, and they can say, for example, that we have the full outstanding balance still left. That means they haven't drawn it down, so that's good. They have access to some credit if they need to, but they haven't drawn it down. So it gives the company a bit of flexibility if things get a bit kind of constricted. So with United States Steel, you just type in the word debt, and on the bullet point number 17, you'll see there that there is different layers of the debt starting. There's some in 2026 and then 2029 and beyond. So that tells you straight away there is no kind of immediate risk. So when I was kind of when I was investing in United States Steel, this was something that I was looking at, that's kind of thinking to myself, if things go a bit crazy here, do I have staying power? Because you as an investor, you want to be able to sell on your terms if possible. You don't want to have to be a forced seller. And if the balance sheet is running against you, and you know the macro environment has kind of slowed down slightly, you don't want to have that time running against you where you have to, you know, in 2 or 3 or 4 quarters, management has to start getting in touch with credit markets and starting to bolster up that balance sheet, because you don't want that. You know, you want to be able to just stick around the business, because if you're buying something that's out of favor to start with, you know, just because you bought it does not immediately mean that the business is going to start thriving tomorrow morning. So you need to kind of have some ability to stay with your business for a prolonged period of time, and having the right balance sheet is an advantage to you. Now, I'll just add one more thing on United States Steel. It's often the case that if the business is has a very strong balance sheet, they will tell you that, right? So if you look on United States Steel's presentations, they will tell you, okay, look, our debt is layered out. Okay, so this is an example that when things are well structured, management will tell you. You don't need to kind of like think about it. It's very upfront in the presentation slides. You can see that straight away. The other thing is, now we're going to talk about 2 different companies that haven't performed particularly well of late. I have them at the top of my mind because I'd written about them before the earnings came out. So I'm using those 2 as an example because I had written just before, like 2 weeks before the results came out, and then the results came out and the stock unfolded. Now, I just want to be clear that I didn't know that in these 2 examples how the earnings would come out. The point I'm trying to make is that you want to make an investment where the probabilities are on your side so that you can have some staying power and you can stay with your investment and you're not a forced seller. So the one I'm going to highlight is Farfetch. And in the case of Farfetch, you can see that the balance sheet, they report in IFRS, which is different type of accounting, is international accounting, and you can see that on their balance sheet, they
Can I interrupt just for a second?
Yeah, go ahead, please.
If you go to Seeking Alpha, and you go, if you want to go to X, the one he's talking about, and you can go down to SEC filings, and that's where you get the information that Mike was talking about. They filed an 8K, which you also talked about. It's a discussion, a letter that they wrote on the progress of their sale of the company. So I want to say.
So say this again. Sorry, repeat that again, please.
Today they had an 8K that went out. So they wrote United States Steel, the one you're talking about.
Right. So yeah, sorry. Yeah, okay, fine. Yeah, I was kind of saying that about if someone looks at Farfetch, one could see that ahead of time that the company's balance sheet was quite restricted. So if you're a business and you have quite a lot of debt, you need to get ahead of that debt before the creditors come asking for it, okay? So typically, you want to give you know that debt is due, let's say, in 2 years' time. You don't want to let the clock run out all the way down, because then you're not going to be in a good place to negotiate the refinancing of that debt. So you want to be at least a year ahead of schedule. So in the case, if something has a substantial amount of debt due in 2 years' time, you want to think that next year, if they don't tackle this problem, that's not going to be a great investment for you to be involved with. So that was with Farfetch. And the last example I'm going to offer was with Peloton. And Peloton is really the same kind of idea here. So they have some notes due at the end of 2027, but they start that maturity in 2026. And I'm going to write this all up for Friday so we can just kind of see through this. The point I'm just trying to make is that I have made this a bit long-winded, but 5 minutes, that's all it takes. 5 minutes, someone looks on the SEC filings, and that can solve a lot of problems for an investor. Because the way that I see investing is like you're running a marathon. The marathon is not run on the day that you show up to run the marathon, on the day that you make the investment. The setup is on the preparation. So where it's basically you ticked all the boxes to make sure that the investment that you're making has certain criteria that can withstand certain aspects of a slowdown in the economy, or if the business is not performing as well as they wanted to. So what you're trying to do is just not to be blindsided, and it doesn't take a long time for you to just become quite familiar with this. You just go and look at certain keywords. So I'll just repeat them one final time. Either look for the words debt or borrowing or revolver. And also often is the case, you can look on the liquidity, so to see if there's any kind of red herrings there on the company's balance sheet. So that's what I wanted to kind of provide as a framework today. And then next week, I'm going to go through a proxy statement, and I'm going to go through just talk about a bit of free cash flow to compare and contrast companies that have the illusion of strong earnings, but the earnings are not actually being backed up with a free cash flow, and how to think about that. So I'll open it up for questions now, if anyone wants to kind of ask something.
When I look at the 10 Qs, which I do a fair amount, I just go to Seeking Alpha generally and pull up the 10Q, and then they have a table of contents, and I generally go there. You must be getting your 10Qs from a different source that you can hit on a keyword and then go right to liquidity. Where do you get yours?
So I just type into Google SEC filings. It's the first one that comes up. They have a search box. They're the official government one. It has for all the companies there, which I think is really helpful, because it's just once you become so attuned to doing that, it becomes quite familiar. Also, the advantage of doing it on this SEC filing website, for example, in certain types of investments where they're going to do an IPO, Seeking Alpha may not have that page set up right yet. And it's kind of nice to be able to check through what is called the S1 filing. The S1 filing is the first kind of official document when the company is going to do an IPO, or if it's, let's say, a reverse SPAC, they will also be registered on the SEC website. And I find that quite helpful, because it's quite intuitive once you kind of done it a few times, and it's just a text-based document as well, so you can just type in Control F to find the word that you want.
That's interesting. So you did a Google search for SEC filings.
Yeah.
And then does that bring you to a government document?
Yeah, it's the first is the first one. So I type in here
Edgar company filings.
Yeah, correct. Yeah, company filings. Sorry, yeah, company filings, and then it's Edgar. Yeah, that's the one. And when you click, it basically says company
name
and person lookup, and you type in the ticker there. And I quite like that, because certain times I have found that that Seeking Alpha may be a bit delayed in publishing something, particularly if it's a company that is not highly followed. It could take some time for them to post that information up on their website, I found in my experience. And when it's on the SEC, it just comes up straight away. And it becomes quite helpful. For example, if the stock is moving up or down quite a significant amount, and you want to know why it's happening, I kind of like going there as well.
I agree. I like it as well, better than what I do. Now I'm into U.S. Steel. I've got the 10K in front of me, and where's your as sections? Where did you put your search for like debt or for liquidity?
So in my example, I just typed in Control F for find, and I put in the word debt, and I can see there's 99 references to the word debt. But because I've already done this before, I can see that it says see note 17 for debt, and that's on page. Hold on a second. Just a second, please. On page 80.
Yeah.
So hold on a second, and it's more detailed on page. Just bear with me a second, please. 92. On page 92, you see a table. I'm going to write this up on Friday, and you can, on that table, you can see that the maturity dates of the senior notes. As I said, they kind of start meaningfully in 2029, but they go out to 2037. So it gives you a bit of an idea of just how much wiggle room the company has.
And that's off the 10Q or the 10K?
The 10Q, sorry, 10K, yeah, 10K. So
10K.
yeah, I typically recommend looking on the 10K in the first instance, because it can be a waste of time looking on the 10Q if they've not updated anything.
Right.
And you kind of end up searching them, and they just reference you anyway to go to the annual. Unless you know that the company has changed their capital structure in the past 6 months, it's not really worthwhile your time to look on the 10Q, the quarterly. Just go on the 10K for the annual. But it's just for the rest of the people. So this may sound quite laborious and quite challenging, but it becomes really simple. It's like once you've done it like 3-4 times, it becomes like really something very quick to do. And yeah, the way that I would recommend is just look to see how big the sums are for certain years. For example, if a business has, let's say, a small amount of, let's say, I don't know, like 50 million next year, and then like 70 million the year after, but like 4 billion in 2027, that's kind of more important than trying to figure out those kind of small amounts that are due in the near term. And also, most reasonable companies would try to kind of structure parts of it with time, because you never know as a company when the financial markets can close up to you as a company. You know, there could be some kind of whatever announcement that like Fitch or Standard & Poor's says that something negative about your company, then your debt can get downgraded, and it becomes quite difficult to raise capital in those instances. So most companies will try whenever possible to get in front of this by at least 2 years. If the debt is due within 2 years and is still kind of coming up, then I'll kind of take that as a yellow flag. I'll be like, okay, something here, they're struggling to refinance on terms that are acceptable right now. This might not be a very good investment. Would anyone else like to ask any questions? Okay. I hope that this is kind of useful. I'm happy to kind of discuss something else if people are kind of interested. If people would like, if people are interested, I'm happy to discuss this new pick that I highlighted today, Moneyline, if people will be interested in that.
Sure.
So the way that I came across it was that Moneyline was founded by 2 guys that came from Citadel hedge fund. So I was looking around, and these guys have quite a lot of skin in the game. There's a lot of hedge funds that put money in MoneyLion, and MoneyLion came to the public markets via a SPAC about 2 years ago, and like a lot of SPACs, it got quote unquote de-SPACed, and the share price sold off quite substantially. It's down about 80 or 90%, I can't remember now, from its highs. But what they do is kind of similar to what SoFi Technology does. SoFi Technology, in my opinion, I know it's a lot of people follow this company. In my opinion, it's expensive for what it offers. And MoneyLion is doing something kind of similar. It's kind of like an app where you can do a lot of different functions, like improve your education in terms of how your finances, keeping buying shares or stock through that app. So it's like a financial wallet of some sort, and it provides a lot of options what you can do with your money. And what attracted to me, and I'm quite attracted to businesses that have a very fast customer adoption curve. I've mentioned this in the past. So businesses that are typically seeing very fast customer adoption of, let's say, higher than 50% year over year for quite a few quarters tells me that the business is doing something right. In the case of MoneyLion, the most recently reported quarter, they had customer adoption curve of 114%. So compared to last year, they've doubled the number of customers using their app. So I kind of like businesses like this. Also, another thing that happened was that last year they were growing really, really fast. And as they compared their revenue growth rates with last year, their growth rate slowed down, because last year they were growing at triple digits. It's quite difficult to grow often against the prior year when you had a really blockbuster year. So people were quite spooked by that. It's like, oh, maybe they're just a flash in the pan, or maybe they just maybe they're not gonna continue to grow at a reasonable rate. But their guidance for next quarter is already reaccelerating back again to about 30% compounded annual growth rate. So that's something that I find quite interesting and attractive. It's kind of like the thesis that I have for myself with Spotify. Often is the case that the business is growing and they have a lot of customers coming to them, but they have like a negative quarter where the revenue growth rate doesn't really match the street's expectation, and the stock can sell off. You've seen over time, this has happened with the likes of Netflix. Netflix sometimes has good quarters, sometimes has bad quarters, but even at this late stage, they're still growing the number of users on their platform, the number of subscribers. So if you have a long, persistent runway of subscriber growth, that tells you that the product or service or the platform has something worthwhile. And if you have a lot of people adopting your platform, that provides optionality. You can later on either raise prices or cross-sell your product or your service. So you can do stuff with it. And most importantly, what I particularly like about MoneyLion is I believe that it's priced at around 2 or 3 times EBITDA. That is not necessarily, something can look quite cheap and can stay quite cheap. That's not the end of the story. Just because something is cheap doesn't mean it's going to be expensive in the future. But if you start with low expectations and it's recently become a profitable business and it's not that expensive, things can happen positively. Whereas on the other side, where people are expecting things to do really, really well and the stocks are priced really, really high, even if they excel with delivering against those high expectations, the stock kind of just doesn't do much. And you always have that risk that some negative news comes out of somewhere. But with the case of MoneyLion, the stock is already down, totally washed out. Anyone that's really holding on to this stock are people that are not going to be selling now. They're just given up, they capitulated on this holding. And if you you just give this business a bit of time, I believe that they can regain their footing. And yeah, as long as the business continues to tick along in that kind of mid-20s revenue growth rates, so, I think that the business is cheap enough that it can kind of be an interesting investment. That's how I'm thinking about it. I'm trying to kind of diversify the portfolio into different areas. Something in fintech is interesting to me, so yeah, I'm trying this out, and I hope that it is cheap enough and the management has a lot of skin in the game that they can turn around this business, and hopefully it will work out. Yeah. So I just published this today. I just kind of wrote about it and published it today. Hopefully people will be able to check it out, and and let me know what you think.
Yeah, I'll take a look at it. Thank you.
Yeah. Okay, if there's nothing else that people want to discuss, so I'm happy to just wrap it up here. Would anyone else like to ask anything? Ask. Yeah.
I think this is on topic. If it's not, or you're going to cover it later, then mention it. But do you look at hedge fund investing, like how many hedge funds own a particular stock, and or who, as far as which hedge fund does?
Never.
Never.
And
Okay.
I mentioned this before, George, that try not to complicate the thesis. Try and kind of slim it down to what is really like the one or two variables that you look at. There's so much data out there, but that's not often. A lot of data doesn't mean better information, right? It's like just because when the stock goes down, you're like, oh, so and so owned it, so therefore it's okay. But you don't know, like maybe so and so owns that as a hedge against something else. You don't know, right? You don't know the ideas. Just try and kind of boil it down to one or two key variables that you can track. And if it's not performing with what you felt it should be, then you're out, just try and kind of slim it down. Yeah.
Okay. And a follow-up to that would it be the same answer you just gave for example, how much insiders holding? Would that be the same answer for that?
No, that would not be necessarily the same answer. So I do value companies that management has a lot of skin in the game. I think that is normally quite indicative of companies doing quite well. But even in that case, you can go through long periods where companies don't do very well. Like the classical example will be Microsoft from 2000 to 2012. A lot of insider ownership, but 12 years, that stock didn't go anywhere. Now you can say in hindsight, Microsoft, if anyone held from those 20 years, they would have done quite well. But you don't have that data when you're going forward, right? You can reverse engineer anything, but buy and hold, I believe that it's nice when management has a significant amount of skin in the game. And the advantage of investing in a company that is relatively small, which is what I typically look at, is that it often has the potential for management to have a substantial stake in the company. It's not always the case. There are cases where, for example, if you're looking at a commodity business, where that's not really the case. You're just looking at the commodity price, like natural gas. That's going to be much more of a upside potential rather than how much management owns. But if you're looking at a product or a service that the company is offering, it's helpful when management has quite a substantial stake in it. But obviously, the bigger the market cap, it's more difficult for them to have such a significant stake. So, for example, Palo Alto Networks, the CEO, it's not like a huge stake there, but that's like close to a 70 billion market cap or something like that. So, that hasn't been the biggest factor driving the share price forward. But then on the other side of the equation, you look at something like Palantir, and Palantir does own, the management does have a lot of skin in the game. So it's a relatively large company, but they're clearly motivated to drive things higher. But that's not the only factor here. So yet the other direction is you can look at something like Affirm, which is a fintech company, and they own quite a lot of shares in the company, and it hasn't really worked out well for them. So just having high insider ownership is not the ultimate factor. It's a nice to have, but I recommend that one boils down the thesis to one or two variables. Really, that's really what you're trying to kind of do.
Thank you very much, Michael.
Sure.
Michael,
Yeah, hi.
yes, your thoughts on China?
Oh man, that's a tough one. I was until 2-3 weeks ago invested in United States Steel, which is obviously highly contingent on China. What I'm thinking and what I'm passionate about is China's aspect in terms of the energy transition. I feel that is something that is going to see a lot of money going their way, but I don't think that the rest of what was the narrative of the last 10 years, which is China building up their manufacturing and their properties and that whole aspect, I think that everyone's kind of come to terms that that's just, slowed down quite substantially. So I think that the story that a lot of people had in the 2010s, where China was just a manufacturing hub, I think that's going to not play out the way that people believe it would. And I think that China is trying to do what the rest of the developed world is doing, which is double down in their services and their technology, and really looking at, let's say, semiconductors and I do feel that the green movement, because they're very much about, you see a lot of the nuclear power plants are being built in China, like really tremendous amount of nuclear energy they're trying to build. So it's a different type of thesis, and that sometimes takes a bit of time to unfold. So like you, I'm also kind of keeping a lookout, but I want to be, if I'm going to invest in China, I want to be comfortable. I don't want to be woken up and then the stock is down 30% because someone said something on Twitter. That's really risky. And like I want my investments to be really boring so that I don't get any headaches. I just don't want any risks. I know it's not the answer you were looking for, but I'm just trying to be honest.
Thanks.
Okay, everyone. Thank you so much for coming. I really appreciate it. And I hope to see you guys next week. Thank you.
Thanks.
Thank you,
Thank you.
Michael.
Thank you so much.
Thank you.
Thank you.